Let's talk about how private equity funds usually work. There are many different types of funds, but private equity funds are usually what are called closed-end funds, where investors invest in what is called a blind pool of investments. So let's cover the actual structure and investment process in a private equity fund. So as we mentioned, private equity investments don't exist in a vacuum. They only exist within the context of their own funds. Any private equity firm usually raises multiple funds, at least if they're successful, and these are successively higher in value than the previous ones if they obtain results. So for example, you raise a $100 million fund, and if it's successful, next time maybe you raise a $500 million one, then maybe a $1 billion one, and so on, at least while you maintain a successful streak. And in some cases, some funds can even be for specific sectors or have specific investment mandates, such as ESG. Because the usual and the optimal structure for a private equity fund is a limited partnership, the investors who put in the money are usually known as the limited partners, or LPs, while the operational partner from the private equity firm that actually coordinates the investments and leads the operations is called the general partner. This is something that exists in common with venture capital. The partners that lead the fund and lead the team are the GPs. The investors that just put the money in passively are the LPs. It's important to note that hedge funds that make private equity investments usually don't follow this structure. They have a different structure. Usually, it's an open-end fund that simply makes individual private equity investments, and they're usually not a limited partnership. So let's go deeper into open-end and closed-end funds. Private equity firms are usually what's called closed-end. This means that the LPs commit their capital without knowing what the assets will be, what's called a blind pool investment, and they have a lockup on their capital, as well as capital calls, instead of all the capital being requested at the beginning. We'll go deeper into this, and this fund usually lasts between 5 to 10 years. This is in opposition to what are called open-end funds, such as hedge funds. These usually don't have a time limit, they're a lot more liquid, and they continually let investors put money in and take money away. Sometimes they do have lockup periods, such as a quarter or a year, but not necessarily. And even if they do, they're usually much less severe than the 5 to 10 year lockup period for a private equity or venture capital fund. So in an open-end fund, you put the money in, you take it away, but in a closed-end fund, once you put the money in, it's not coming out until the end of the fund. The GP of the fund, or GPs, usually report performance on a quarterly basis to their allocators. And to be very honest, in many cases, this is futile, because it's impossible to properly estimate the value of these companies and these investments until they exit. But the allocators do require these reports, so it has to be done. And remember, the J-curve also comes in here. So all investors expect any private equity fund to report negative returns in the first years when they're pouring capital into investments, then break even by year 3 to 4, and then to start harvesting returns from there onwards. So with this lockup on their money, usually the LPs have no way of taking their money out of a fund until the fund expires, which makes it harder if there is a liquidity emergency. This is why recently something called a secondaries market has been created. So what happens is that an LP can buy the interests of a present LP under the same conditions. So in terms of the fund, nothing changes. But it allows an investor that wants to leave the fund to have liquidity, because they sell their position at an estimate of its value to someone who comes in and replaces them under the same exact conditions. It's called a secondaries market because if you come into a fund as an investor, at the beginning, it's called a primary transaction. But if you're an LP that is replacing an existing LP, that's called a secondary transaction. But this market hasn't completely matured yet, and it's also dependent on the fund GP to facilitate the transaction. Usually, a portion of the fund capital is reserved for operations. It's usually 2%, And that is what pays team salaries, travel expenses, consultants, due diligence operations, and most other operational activities for that fund. There are usually costs that are not affected by this, that are not included here, like office space, for example, because that belongs to a firm and it doesn't belong to a specific fund. And this is the part where you realize that depending on the size of the fund, this value can vary greatly. So 2% of 400 million is 2 million, but 2% of 4 billion is 80 million. So depending on the total raised for the fund, the GP can find themselves obtaining a radically different quality of talent and consultants available, as well as a very different type of time and quality to be put into due diligence and other operations. So usually what happens is a self-reinforcing cycle. Private equity firms that raise subsequently bigger funds and secure more and more money are more successful, which increases their investment quality and the quality of their operations, which lets them raise bigger funds and continues the cycle. Usually, there are two main types of investors, of LPs, that invest to private equity and any other kind of alternative asset, really. These are private or retail investors and institutional. So private or retail investors are usually family offices or high net worth individuals, while institutions are usually university endowments, pension funds, insurance companies, and others. Institutions usually invest higher amounts and also have higher pedigree as investors, but they also have much better provisions, demand more transparency, and even specific provisions. They demand what are called institutional quality operations. Mostly in the hedge fund industry, this is a term that is used to define a fund that has the required sophistication to take money from institutions, as a fund with institutional quality operations. If you haven't reached that stage, then you can still obtain money from retail investors, but you have to up your game to be able to receive allocations from institutions. There are multiple provisions at stake when receiving an allocation, the most famous being the management and performance fees, the proverbial 2 and 20. Investors allocating high amounts, and especially institutions, usually demand much lower fees. Usually, the management fee is heavily negotiated because it's something that the team receives without needing to actually obtain results, while the performance fee or the carry is usually not negotiated. The investors don't care about it because that fee is only charged if they get results anyway. But here's the thing, there are many other provisions that can come in here, and these provisions alone can make any investment seem very attractive or a complete nightmare based on these alone. So one of them is transparency on the fund financing, especially credit subscriptions. This is required by many institutions because the GPs can inflate returns by using credit. Let me give you an example. If instead of requesting 500 million from investors in a round, you only request 250 million from them and you get the other 250 from a credit facility, your returns will now seem double because you obtain the same returns with only half the money required from investors. So allocators that are not aware of how credit subscriptions are used may fall trap to inflated performance metrics. And this is why the sophisticated ones request transparency on this or even limit the use of them. Key person events come in here as well. GPs are usually required to devote time to the fund, to have no other professional activities, to put in their own money, and there are even termination clauses under certain conditions, and it may allow a GP to leave, possibly with a part of their carry or not at all. There are also provisions governing what are called the distribution waterfalls. So whether the GP receives returns for the fund as a whole or on a deal-by-deal basis, also known as the European or American models. And these are different because there's a possibility of, in one of them, the GP receiving more earnings than they should. For example, if the returns are considered only for specific investments instead of the fund as a whole. Because, for example, a GP can receive returns from a positive investment while ignoring another negative one that has the same or even bigger value. And this can result in something called a clawback, where the investors at the end stage of the fund calculate the excess returns that the GP received, and as the name says, they claw them back. And this can be very uncomfortable because the end date of a fund is usually 10 years after. So there are cases where a GP makes 20 million or 100 million that they shouldn't, and 10 years after, maybe after they've spent it, the investors come back and they say, by the way, we're going to need 80% or 90% of that money back. There are also rules governing fund extension and restructuring. So usually the GPs can extend the fund twice for 1 year each time, which is useful, for example, in case the investments haven't matured yet, but they will in the near future. And they can also restructure a fund, which is good, for example, for when the fund has kind of gone zombie with no progress in investments, but the investors don't want to wait until the end of the fund, and they want to obtain some sort of liquidity right away. There may be also what are called custom provisions here. So an investor allocating a much higher quantity of capital than others may request much smaller fees or complete transparency, as well as other specific provisions such as the MFN or Most Favored Nations clause. This is a type of clause that prevents a GP from favoring another investor, and it forces them to, whenever they give better terms to an investor, give the same terms to this one as well. So if an investor requests a Most Favored Nations clause and they have a 2% management fee, if the GP offers a 1.5 fee to another investor, this one immediately gets 1.5 as well. They may also request other specific terms in terms of transparency, returns, or whatever matches their specific needs. So it should become apparent now that money isn't everything, because if your biggest investor allocates a very significant amount of money, but they pay almost no management fee, they make very high demands in terms of your time and your own capital. If they're allowed to kick you out as a GP for no reason and not give you any of your returns, if they also require validation for all fund extensions and restructuring, and they prevent you from giving favorable terms to other investors, you can easily see how, regardless of the quantity of money, you are not going to operate freely. There is a particular case of interest, which is when a GP is not able to obtain returns at the end of the lifetime of the fund, or even if they obtain moderate returns, but they want more. So let's say that the 10 years have passed, but the returns are not attractive. There's two main things that can happen here. They can extend or restructure the fund. So extensions usually happen for periods of between 1 to 2 years. And usually they can be done once or twice maximum, led by the GP without needing LP approval. So you can extend for 1 to 2 years, that still isn't enough, and then you can extend again for 1 to 2 years. But there may be further extensions that need LP validation. And this is a dilemma because some LPs may want to get the money right away, while others want to stay in and get better returns later. And if that's the case, this usually results in a restructuring. This allows some LPs to either roll over their interests to a new vehicle that is extended or to liquidate and obtain money. So if you have 10 allocators and only 4 of them want to extend, you restructure the fund, and the new fund with the extended date only has those 4. The private equity firm can also do another thing, which is a sponsor-to-sponsor deal, and this can be legitimate or kind of shady. In short, what happens is that the private equity firm sells the company's stake to another private equity firm, which allows them to keep doing the job. So the company is repeatedly flipped among firms until it becomes a successful investment. And in some cases, this does work. The first firm gets some results, flips it to another private equity firm that takes it to the next level, and it keeps on going like that. But in some cases, there are no returns or optimization, and the company just keeps being flipped in hopes that it will one day yield returns. This can be suboptimal because it's a nightmare of transaction costs. You need to realize that Every time the company is sold, there are costs, and the ones paying them are the investors. But on the other hand, they can also have a positive side, because if the company is sold to another private equity firm that is also focused on performance, the due diligence, for example, is much faster. So the new optimization gets a jump start. As everything in life, it's a trade-off. So as we see, it's important to understand how a private equity fund is both created and raises money, as well as the different types of allocators and the provisions that they usually request.